In this video, I've chosen the 5 best low-risk monthly dividend ETFs for 2023. I think these ETFs are going to give you the highest returns possible based on 3 criteria. Number 1, the ETF is at least 5 years old, which means we can see the ETF's performance during the crash of 2020, we can see it during the run-up in 2021, and we can also see it during the bear market in 2022. Number 2, the ETF has recovered from its 2020 lows and traded higher than its pre-2020 crash levels. And number 3, the ETF pays a monthly dividend of at least 2%, which is the Federal Reserve's target rate for inflation. Let's jump into our first ETF, DGRW, also known as the WisdomTree US Quality Dividend Growth Fund. This ETF seeks to track the investment results of dividend-paying large-cap companies with growth characteristics in the stock market. In other words, this ETF picks large companies to invest in. These companies pay dividends, but the ETF also screens them for growth as well. So the idea is that by buying this ETF, you would be buying shares and collecting a dividend, but because the companies are also growing in value as well, so would the shares of the ETF, which would further add value to your portfolio. DGRW has 295 holdings, and its top holdings include Microsoft, Apple, Johnson & Johnson, Verizon, Procter & Gamble, Pfizer, Coca-Cola, Altria, Cisco, and Pepsi. This ETF has a 5-year average yearly return of 10.88%. So that means if you invested $10,000 5 years ago, your investment would now be worth $16,723.53. DGRW has a dividend yield of 2.01% and an expense ratio of 0.28%. Now I know what you're thinking, a 2% dividend yield really isn't all that exciting. Well, it only goes up from here. Our second ETF is DHS, also known as the WisdomTree US High Dividend Fund. This ETF seeks to track the investment results of high dividend yielding companies in the US stock market. For this ETF, the investment strategy is very simple. Buy companies, hold them, collect a dividend. DHS has 311 holdings, and its top holdings include Philip Morris International, Altria, AbbVie, Pfizer, Cisco, Verizon, AT&T, Coca-Cola, IBM, and Broadcom. This ETF has a 5-year average yearly return of 7.48%. So if you invested $10,000 5 years ago, your investment would now be worth $14,325.47. DHS has a dividend yield of 3.18% and an expense ratio of 0.38%. Our third ETF is SPHD, also known as the Invesco S&P 500 High Dividend Low Volatility ETF. This ETF focuses on 50 companies in the S&P 500 that historically have provided high dividend yields and low volatility. So SPHD, in my opinion, is a great option for income investors. With this ETF, you don't have to worry about volatility as much, and you get a consistent dividend. So this ETF isn't focused on growth nearly as much like some of the other ETFs on this list, but for some investors, they might want that because that can take some risk off the table. SPHD has 53 holdings, and its top holdings include Iron Mountain, Altria, PPL Corp, Williams Companies, AT&T, Kinder Morgan, Philip Morris, Chevron, Prudential Financial, and Amcor. This ETF has a 5-year average yearly return of 5.14%. So if you invested $10,000 5 years ago, your investment would now be worth $12,839.14. SPHD has a dividend yield of 3.72% and an expense ratio of 0.3%. Our fourth ETF is PEY, also known as the Invesco High Yield Equity Dividend Achievers ETF. This ETF focuses on 50 companies on the basis of dividend yield and consistent dividend growth. This ETF strategy is great for long-term dividend income investors. This ETF is focusing on the growth of the dividend itself. So as time goes on, the dividend should be paying out more every single year. PEY has 54 holdings, and its top holdings include Altria, OneOak, AT&T, PPL Corp, ExxonMobil, Philip Morris International, Northwest Bankshares, Universal Corp, Edison International, and OGE Energy. This ETF has a 5-year average yearly return of 7.72%. So if you invested $10,000 5 years ago, your investment would now be worth $14,484.11. PEY has a dividend yield of 3.86% and an expense ratio of 0.52%. Our fifth ETF is DEVO, also known as the Amplify CWP Enhanced Dividend Income ETF. This ETF is actively managed and consists of large cap companies with a history of dividend growth and uses a covered call strategy to generate returns. DEVO is a little different than the other ETFs on this list because it uses options to generate more returns. Now, this is a little bit riskier, but it does increase the yield pretty significantly. DEVO has 28 holdings, and its top holdings are United Health Group, Chevron, McDonald's Corp, the Home Depot, Visa, Procter & Gamble, Goldman Sachs, Johnson & Johnson, Microsoft, and JP Morgan Chase. This ETF has a 5-year average yearly return of 11.04%. So if you invested $10,000 5 years ago, your investment would now be worth $16,874.52. DEVO has a dividend yield of 4.64% and an expense ratio of 0.55%. The time of easy money, stocks only go up, we're all gonna make it is over. Bottom line, these ETFs in this video made long-term investors money in the form of a monthly dividend and in the form of growth. And it did all of this during a very tough investing year, 2022. The thinking is that if these ETFs performed really well during the past few years, then it'll likely continue that trend as time goes on. In my opinion, there's a good chance they'll continue to perform well in the future with low risk and high rewards compared to some other investments. Of course, no one can predict what's gonna happen in the markets moving forward, and there's no guarantees that any ETFs on this list will actually make you money in the future. Let me know if these ETFs have a place in your portfolio in the comment section down below. Thanks for watching. Be sure to like and subscribe for more crypto, money, and finance content. I'll see you on the next video. Have a good one.